Have you ever heard of those lenders saying,
I will give you a business loan in a few hours right into your big account.
and you go,
Great! Thank you for that money.
do you know that this money can be killing your business before you even realize it? But, but, some business owners are making a killing with this loan. So, how can a business loan can be either a business maker or a business killer? It comes down to one rule. Let's dive in. What is a revenue based loan? You see, it's a short term loan based on your business revenue. It's also called working capital loan, although there are different types of working capital loans, like based on your account receivable, etc. Right? But nowadays, most working capital loan that are out there are revenue-based loan. Also, you'll see it called MCA, a merchant cash advance. Why? It's because when this loan first came out, it used to be based on your credit card sales as a merchant. So it was called merchant cash advance. However, this loan has changed a lot. So it's based on your total revenue. The best way to look at it is like a payday loan, okay? A payday loan is for people who have a job and then they're paid a salary, like a paycheck, and then you do a loan on that. So the revenue based loans is similar. It's based on your business revenue instead of your paycheck. So consider it a payday loan for your business based on your revenue. The math. You need to quickly be able to figure out how much you can get approved for, right? So again, think of it as a payday loan. If you get paid $1,000 on your next paycheck, your payday loan will be around $1,000. Same as your business revenue. It goes with your business revenue. So here's the formula. You see, your average monthly sales will be your average loan amount. So as an example, if you make 50K a month, your average loan amount will be around 50K as well. Or if you make $200,000 a month, your average loan amount will be around $200,000 as well. Very simple math, guys. By the way, if you like this type of content, please subscribe to our channel to support our work. The cost. This loan works very differently from the regular loan that you know that uses an interest rate or APR, right? Now, this one uses what they call a factor rate. So, the factor rate is a multiplier that tells you how much you will pay back at the end. For example, let's say you borrow $100 at a factor rate of 1.2. So, the factor rate, right, being a multiplier, when you multiply it by $100, at the end, that gives you $120. This is your total payback. This is a set fee, regardless of whether you pay back in advance or not. This is the fee. So, or factor rate, in general, it's between 1.14 to 1.45, where the average factor rate is around 1.3. Let's say 1.27 to 1.3. So, very easy calculation, guys. This loan's superpower. Superpower number one, speed. Now, this loan you can get approved within hours and get funded within hours with the money in your bank account within hours. Compared to any bank loan, it is very much more efficient, like a lot more. Superpower number two, you can get approved with low or no credit. As long as you manage your cash flow well, you are good to go. However, credit counts for a lot, meaning that the better the credit, the better rate that you will get. And if you have a bad credit, then the rate will be a lot higher because the loan will be a lot riskier. Because of that, the barrier for entry is a lot lower. So this is why this loan has been the fastest growing in the industry and for a long time. The big disadvantage, a revenue-based loan is a short-term loan. Therefore, you have to pay it fast over a short period of time compared to a regular loan where you have a longer period of time. Let me give you an example. Let's say you borrow $120, right? If you have 1 year to pay it, right, that will be $10 a month that you need to pay back. But if you have, let's say, 2 months to pay it, that's $60 over 2 payments, right? So what happens is that the payment is higher compared to a regular loan. It's not that the loan is more expensive, it's just that the time is compressed. And because of that, payments are either weekly, bi-weekly, sometimes we have monthly, and then you know what happens often too? You have daily payments. So with this type of payment over a short period of time, if you do not manage it well, it will be too big of a cash flow drain on your business. Therefore, I guarantee you, you will lose sleep at night. And this is exactly how to kill your business. The solution, one rule. Guys, tattoo this in your brain. This is the one rule. It's called profit based, meaning that this loan must make you make money. If it doesn't make you make money, do not take it. For example, let's go back to our prior example. So if you borrow $100 at a 1.2 factor rate, you will have to pay $120 back. Now, let's say using that money, you make a profit of $300. What I mean by profit, your margins, okay? After your cost of goods sales. So no matter what you sell, let's say you make $300 on top of that. So $300 minus 120 is $180 in profit. So basically, borrowing this money for a short time made you make a $180 profit. So this is free money at the end if you do it well, just like this. And I forgot to mention, usually um, for this type of loan for us, it's short term. Your payback period will be between 6 to 13 months. The average is 6 months. But on the market, you'll see anything between 3 to 24 months, and even sometime 1 month. Because when a deal is too risky, some lenders will ask you 1 month to pay it back. Just FYI. Meaning, when you borrow that money, you need to be certain, 100% sure that you will make money with it. If that loan makes you money, take it any day, each day. But if you're using this loan to pay bills, all right, or just to survive, this will kill your business. Run for your life. Do not take it. You see, and this is coming from personal experience. I've been on both sides of the aisle. So back in the 2010s, early 2010s, I used to run a high-end fashion company, right? And we use this loan, let's say, to buy inventory, etc., before the holidays, as an example. So when 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 I borrowed this money, I know exactly how much money I would make, and we made a killing with that. At the same time, a few years later, the company had trouble, and I did this loan just to survive and to pay bills. And that was one of the reasons why the company went under. So again, guys, you need to make money with that loan. If you cannot make money with that loan, do not take it. The bottom line, before you take a revenue-based loan or an MCA, ask yourself, will I make money? If the answer is yes, do it right away. Each day, any day. It's basically free money because this is money that makes you make money, right? But if the answer is no, or even I am not sure, do not take it. Just run. If you need a quote on a revenue-based loan, I put a link for you down below. It will take you 5 minutes to apply, and we'll get back to you shortly after. And if you like this video, you will love that one.